Hello, folks. Welcome to Market Trends. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone again today, Thursday, July 17th, 2025. All right, we're going to start with some disclosures. Now, remember, you can go to tradestation.com, and if you go down the homepage, you will see the blog post with some of the key points we're going to be talking about today. It is an interesting day because it's reminding me of the period in late 2023 when the market really started rallying on a sense of the Fed, being ready to cut rates, and, and so these are the standardized returns. And it's not exactly the same, but I would say the actual the news is not the same, but the sentiment is similar, which is extreme fear giving way to disbelief and a lack of selling. I think that's the way to think about it. So you go to tradestation.com and scroll down the page, and you'll see here has this bullish pattern. I talk about that because there's a certain pattern. I'm the only person I know who's described it in this way, but I'm not the only person to know. Essentially, this is loading slowly. Um, Actually, I need to also share some disclosures. Good. All right. So here's a price chart we're working with. I'm going to open this up and put this in its own tab real quickly. And what you can see here is this is the S&P. And essentially last week on the 8th, and then we went down yesterday and we just touched it just above 6,200. This movement, if you look at this, is similar to some of the price action we saw back in late 2023 and early 2024 as the market came off the lows. What you'd see is the market essentially would rally and then you give a sideways movement. You didn't get like a pullback. I mean, this is like a pullback here, but the key thing is it was a sideways movement. The real ones I want to highlight with this, when you see this just goes sideways and you don't get a real pullback, you just get, it will go along sideways and it will stab down and hit some flat lines, some flat levels from 3 to 5 to 10 days before. And what do we see here? If you look at the S&P, I'm going to look for actually on this chart really quickly because it's easier to show really fast the S&P here. Sorry. You can see here essentially that we had this level. Let me just even hide this. You can see this level right here went down and we held it. That was the 7th, not the 8th. And so when you see this kind of price action, we had drawn this line previously, but I can move that line up. And essentially the key thing here is that it's not able to break lower and it holds a tight sideways movement. And this is something that shows a lack of selling pressure and an overall kind of comfort in the market. And I think what's interesting is that we look overall and we don't see the ability of the bears to take over in this environment right now. We're essentially seeing scary things happen and they have no ability to kind of stick. And so I think what's interesting is when you look yesterday, we had all this news about, Jerome Powell and things like that. And none of it really played out. And none of it looks like it's going to be able to play out. It was some kind of report, and then Trump himself immediately kind of dismissed it. And then a bunch of senators came together, and they put together some kind of message saying, please don't get rid of Powell. It'll mess up the bond market. And so very quickly, you kind of have these, horrible fears, and then they just go away. And this is what happens in a bullish market. I think in some ways, it doesn't really matter what the subject is. What matters is you have these fears that get, dissolve, and then people who sold end up getting burned. And then what happens is people who bought the dip get rewarded. So this is how a kind of tight kind of bullish market works. If you look at the sentiment indexes like the American Association of Individual Investors, it actually got more bearish this week. So as the market is going higher, sentiment's getting more bearish. And this is kind of consistent with a tight upward market or the classic kind of wall of worry. So I think right now people still have a hair trigger sort of reaction. Look at the news this week with the inflation numbers. There were some signs, and there are signs of inflation kind of trickling through in certain things like appliances and things like that. But I think there's another way to think about this, which is in some ways we kind of had the first 6 months of the Trump term or whatever it's been, and all these scary things, tariffs and all this stuff. But like to kind of paraphrase Winston Churchill, this could be the end of the beginning. He said that at a certain point in World War One, where the worst part of the early German victories were over, he said, "Oh, it's the end of the beginning." And now, what happens if that's where we are now? What if this is the end of the beginning of the Trump administration, and essentially the kind of worst case impact of the tariffs and all that stuff? What if it's essentially over? What if we actually know as well that despite the rhetoric, Jerome Powell is not going to be, removed? So that these kind of worst case scenarios, and remember, when the market was actually crashing back here, this second low on April 21st was because there was a report Jerome Powell was going to be removed, and then essentially Trump denied it. And then there were articles in the Wall Street Journal that Scott Bessent really stepped in and said, "Don't do that, Mr. President." So again, we are seeing these sort of things play out, and I think this is important to realize is that the worst case scenarios are not panning out. And this is what the kind of bull market scenario is. So the worst case scenarios being worst case tariffs, worst case inflation, and worst case Fed. Each of these things, we have the tariffs with some inflation, but there it is. It's not absolutely overwhelming yet. And at this point in time, given the cash on the sidelines and other positives, like, for example, today's data, like we see with retail sales, relatively strong, jobless claims. I mean, retail sales are actually pretty strong overall. Jobless claims not going higher. So we're essentially getting no recession here. And we're also at a spot where yields are not, they're just kind of sitting and waiting. And I think that's an important thing to realize. You look at it here with the treasury yields, we can essentially see that we're sitting here and nothing really is happening. So this market is in a spot of just a bunch of kind of nothingness. In terms of, I shouldn't say a bunch of nothingness overall. What I mean is the macro big fear volatility inducing events are just kind of not happening. The things that could be really problematic, like yield shooting higher, are not necessarily happening. Today, we also, we've seen things like gold weaken and stuff like that. So all of these things continue to show that the fear is kind of melting away, and that's what we essentially see in this kind of pattern. Now, I want to point people forward a few things I think it's important to realize. This just jumped on the calendar. On Tuesday, Mr. Powell himself, 8:30 in the morning, will be speaking. And then after that, we basically get into earnings. Tonight we have Netflix. And then after that, we start getting the big names like Alphabet. And then we'll start getting into more tech. And the following week is when we're probably, I'm not sure yet, but probably when we're going to have things like Meta and Amazon and those bigger names. So, but in some ways, this in some ways is an interesting kind of point to watch. So I think it's important to realize here is that essentially, let me just go make sure I'm not missing anything. Essentially at this point in time, I think the big way to think about this is at the end of the beginning in terms of the worst sort of fear and the worst volatility and shocks like that from the Trump administration, the kind of the Trump policies that have been done. Now, as we actually step back and look, what we're really seeing is with our volatility cycle, the idea that markets go through a period of correlated movement. When things are bad, then everything crashes together, the VIX spikes, and things are correlated. And then when they rebound, the initial rebounds are highly correlated. But after you get to that spot, and we're well past that, you get in that spot of low volatility and stock picking. And that's a lot of the stuff happening today. And we're going to look at some of these things on that kind of lower level. So I wanted to kind of point that out. And in some ways, I would also mention that this environment right now is really the best kind of environment for the stock market. It's similar to the late 90s when essentially inflation was moderating, coming down, and you didn't have a lot of rate cuts. Rate cuts are not really a good thing. Rate cuts mean the economy is weak, and then you also have, other sort of issues. And the thing is, normally rate cuts are, you want the market to crash and then the rate cuts. There's a horrible fear, then the rate cuts bail you out. But when the market's just going higher, rate cuts are not something that historically is really the way the market wants to kind of react. And I think right now, focusing on the stronger economy and the fact that maybe we don't have as many rate cuts, because the key thing is right now, if you look at the idea of the Fed being forced politically to cut rates, that means the long end of the curve moves higher, the 10-year treasury, the 30-year yield move higher, those yields move higher, and that is going to hurt a lot of other things. So I think at this point in time, it's interesting to kind of see this worst case scenario get walked back. All right, so now let's look at some of the other I'm going to jump back over to my TradeStation platform here. So these are the standardized returns. I'm going to jump over to the key ETFs and just show you some of the things that have been kind of performing here. If you look kind of in the last month or so, there's been this clear leadership in the metals. And I want to just point out here that platinum, we talked about it back, I think, on May 21st. We did an article on let me hide myself. We did an article on platinum. On our blog and also on TradingView. And it's interesting to look here at the continued upside. So we did the article back here, I think it was. And so we had noticed at the time that platinum as a ratio to gold was historically inexpensive, and now it does continue to make a new kind of multi-year high here. It's just kind of blitzing higher. And this is interesting at the same time to see platinum clearing these kind of levels here. So now platinum is back to levels last seen in 2014. But it's interesting also to take a look and see gold also is just kind of languishing here a little bit. And this in many ways is that this is a bullish mix of price action to see gold doing nothing and platinum breaking out. And industrial metals doing well. This is showing a cyclical sort of belief and cyclical outperformance. And I think that's a really good. I mean, if you want a bullish market environment, if you want an economically positive story, that is what you want to be seeing. Now, one of the things also, let's take a look at our key ETFs and look at like the performance in the last. Sorry, let's go. Sorry, my computer being strange. All right, so we can actually see, like I said, in the last month, you see metal strong, but in the last like 2 weeks, what do we see? We really see strength in things like small caps, industrials. Look over here on the spider funds, we see technology, industrials, strong. And I think industrials, we've talked about this, but in many ways, industrials now are in a position where they are kind of replacing things like consumer discretionaries to a certain extent as one of the leadership areas of the market. I think this is actually very interesting to see what's been happening here with industrials. We were talking about at the time the breakout in the industrial stocks, and it has kind of seen the follow through, and it has given us a sense that there is this kind of no recession environment, this no recession outcome that the market is focused on. But I do think it's also important to realize that it's a different kind of market than we've seen for most of the years. In many ways, in 2021, we started seeing the industrial enterprise side outperforming consumers for the first time in decades. And now, in many ways, what we're seeing a continuation of that pattern from 2021 and 2022, when the Inflation Reduction Act encouraged factory investment. Now we're just seeing a continuation of it. We're seeing the continued leadership of industrial and enterprise outperforming consumer. And I think that's just something, again, that we have to realize it is kind of a new normal. And but it does mean that we need to look at some other stocks than we maybe have historically. Now, another quick thing I want to look at very quickly is the dollar index. Let's take a look at this because we had talked about the dollar index and essentially, we had talked about how it had completed this downtrend. And from my view here, I mean, there was this level here I'd kind of pointed out around 99.44. But I think overall, the key thing is that this downtrend, could be essentially broken. It doesn't mean that the dollar is going to go up significantly, but we could be in a period here where the dollar does kind of stabilize. And in some ways, in this environment, a stabilizing dollar has also it could be more associated with yields stabilizing, potentially kind of inching lower. Remember, when we had the whole environment of yields spiking higher, that was because people were dumping dollars. So if we do have a period here of dollar stability and some modest strength, that actually could put everything under control to Treasury market again. So I actually would kind of suggest that imagine a scenario here that we could see if you kind of try to jump your mind forward. And this is what, I think is a way to think about things. You jump forward to say Tuesday afternoon, and maybe Jerome Powell has spoken on Tuesday morning, and maybe he has essentially reiterated what he has said all along. And today we had Adriana Kugler reiterating essentially there is a few people on the FOMC who want to be dovish, and they're a minority. It seems like there's a Waller and Bowman. They seem to be kind of pushing in the direction of earlier cuts. The other Fed members are not so much in that direction. So Powell could simply come out and repeat what he has said before, and then we could simply see, okay, we've now accepted the fact that September is a possibility for for rate cuts, but it doesn't really matter. And this drama maybe kind of can fade. And if we go back to an environment where there's no longer as much political pressure on the Fed and the economy is solid, then we can be in an environment where we might actually just see a degree of moderation and then some flattening of the curve, the longer yields coming down, even without the Fed cutting rates. And that would be an environment that would then set us up, potentially for, more kind of a stable sort of continuation and a return to the idea of the American economy growing and not the idea of capital flight. And then we can say, you know what, AI data centers, it's all great and stuff, but then we also have banks, we also have industrials, we also have even some potential for some consumer discretionaries at that point in time. And the other one I wanted to talk about here, which I thought was kind of interesting, and I think we got to realize, is the home builders have absolutely taken a beating here. Now, last week we had talked about the potential of a kind of a dovish sort of development kind of taking shape, and it kind of had. And like it's been a seesaw, but the key thing is we talked about the beginning of stabilizing in some of the home builders here. Now, tomorrow morning we have housing starts and building permits, and today we had the sentiment from the National Association of Home Builders, NAHB, and it was kind of just where it's been. But the fact is now is that home builders have so much bad news priced in. There is sometimes a tendency for these stocks to rally after the data comes out. So I want to just kind of mention D.R. Horton, Lennar. These stocks have really, taken a beating, and there's a lot of bad news priced into them. So I think that this is something where sometimes we have actually seen them rally on the news of those monthly numbers of permits and starts. So I want to just kind of mention that they also report earnings in the next. A lot of these companies you can see, they report earnings soon. So right now we have an environment with just a lot of bad news priced in. And so this is something that maybe we can see the pendulum swing back. And I mentioned that because last week in our market trends, we talked about a company like Open Door Technology. Well, this is a housing tech stock, and look what it's done. OPAD was another one. And so, you're starting to see here a degree of, I think, peak negativity in the housing stocks. Now, the housing market could very well see home prices fall for a while, but in some ways, falling home prices is not necessarily the worst thing overall, because the thing is if the volumes start to move and we get to an environment where we feel that the worst has happened, the market can look past that. And despite whatever anyone says about how terrible the housing market is now, the United States still does have a structural shortage of houses. And once this kind of extreme paralysis in the mortgage market passes and we start getting activity again, you still have more of a structural sort of shortage of homes. And so people looking here at some of the home builders long term, look at like the weekly chart here of a name like Lennar. Sorry. Come on. These names have really pulled back. And if you look at these over a period here on the weekly, if interest rates stabilize and inch lower, and you look at the overall, valuation on these stocks and everything else, if we do, I'm just pointing out here, this is a market here where this is a chart where it's pulled back, and it has basically given us on the weekly, it has pulled back and priced in a huge amount of negative news. So this might be something where if we actually start to see interest rates stabilize and inch lower, this could be an environment where people looking into the second half of the year, into year end, might actually start to look out there, because these stocks trade at very low multiples. So I wanted to just mention that. All right, now there's lots of individual little stories happening right now, and actually, I briefly wanted to go back and just explain this historical pattern. These sideways type movements. Interesting. The last thing I'm going to mention here is you have the 8-day exponential moving average coming up. Now, if you look at the S&P as well, we're basically holding that 8-day exponential. You can see where it held that tight kind of pullback. And the other thing I want to point out here is the 9-day rate of change can kind of just inch along. I mean, if the 9-day rate of change more or less stays at like between 0 and like 2, you're essentially means that the market is gently grinding higher. And this sort of environment can kind of become something that accelerates and ramps higher. So I think we have to realize here with this low volatility and the market broke out to a new high above February, and we didn't get any kind of significant pullback. In fact, we pulled back, and what did we do? We actually held a weekly low from not that long ago. So, jump over here in the dynamic chart, easy to show. And the key thing is I had identified a pullback level here at the this level from July 1st. We didn't get to it. Instead, we pulled back and we held a higher low. And I've noticed this reminds me exactly that time in 2023 and early 2024. You go, you look, you set your pullback levels, and they're not reached. Instead, support develops at a higher spot. And all this is kind of consistent with that tight lack of sellers and money on the sideline kind of environment. All right. Now, there are some other names. So I'm going to jump back over to I think I covered all the things in this I wanted to mention, but don't forget about one of the things we try and do in this webinar is help you kind of plan ahead. And I think it's important to realize that this just popped up on the calendar, and this could be a big event next week. And we do also have the housing starts and building permits. We have Netflix tonight. Maybe we'll take a look at that one. But first, actually, also one thing I wanted to mention here is that the Fed Watch tool, if you look here in the CME Fed Watch, you can see that nothing has really changed yet for September. The September is still at about, right around a 50 to 50% rate cut in September. And so I think this kind of actually shows, we've been through a lot of emotional turmoil with, Jerome Powell allegedly getting fired and all these things happening, not happening, a little bit of fear about the tariff inflation. And we're stabilizing here at an area where the market is now kind of comfortable with it. So we could be at a spot when all this kind of craziness over the Fed and inflation and everything else has, essentially kind of has passed and faded. All right, now let's look at the TradeStation platform. I think there's some interesting things here. So I mentioned the key ETFs, and just this is what this all right, computer, and I'm going to get a new one, and so hopefully this misbehaves. The problem is I have all these things saved on this computer, and it's a big endeavor to move over. But the thing here is we can actually look and we can see that all of our the risk on sectors continue to outperform. As we've mentioned, healthcare just remains in a very problematic spot. When we did State of the Market on Monday, we had kind of mentioned how healthcare was at the top of the range, and it had that risk of bleeding back down, and that's more or less what we're seeing here. So I'm going to just quickly mention right off the bat, applied materials. These are just some things I'm looking at. And in this market, like I said, it's going to be individual stocks kind of giving opportunities potentially. But today we had Taiwan Semiconductor came out with strong quarterly results and kind of confirmed that the semiconductor story remains in place. And so now I think it's interesting to just kind of see a stock like this. It pulled back because ASML, the Dutch semiconductor equipment company, had some weak results not that long ago. It dragged down the semiconductor equipment companies. But when you look at the overall, look at the SOX overall, semiconductor index overall, it is continuing to push higher. So I wanted to point that out as one that's an interesting kind of pullback in applied materials. Now, today, look at Toast. TOST. This is a fintech company that does payments and e-commerce for restaurants. So this company has been in an extremely tight range. I've been looking at it because it kept hugging that 21-day exponential moving average, and that pops up on radar screen. And today it got a bullish note from Deutsche Bank, I think it was. I think they reinstated it. This is just kind of interesting as well. This company, if you look at this, has been in a pretty steady kind of uptrend. I've been using this blue color to hide so I can see the difference between my weekly and daily charts. But again, to see this kind of high basing pattern here, it's been up here for basically since the beginning of May. So it's like a 2-month consolidation pattern up here, kind of around 42. And I think this is interesting with this note here. This will say it might be the start of a breakout with some potential for continuation here in TOST. So now another one this is more one that's pulled back is Micron. Now Micron had a strong run. It really ripped off these lows, and I'm going to it's important, I think, just to notice the way it rallied and held down here. This was their earnings report, rallied and held, had this explosive run, and now it's had this just kind of stalled. But if you look at this now, Micron, this could be an A, B, C correction potentially. So what's interesting is you have some support levels from over here. And it's tricky to always know, will it be this support level? Will it be this support level? The short-term momentum is kind of ugly in this. However, people can say that this is now something where it's had, this was a strong earnings report. The rest of chips are strong. It just had a technical sort of reversal and stalling here. So people might want to say, in an environment like this, instead of spending money to buy something, we can try to look to collect potentially a credit. So this is our Option Station Pro on TradeStation's award-winning platform. And what you can also see here, so for example, say a person was to say, I think it's going to hold around 110 or not go very far below 110. See the 50-day moving average coming up. They could go and look to sell a put credit spread. Now, we want to be looking, in this case, you can see I'm looking at the 25th of July expiration, which is 8 days out. Now, if you look at options that are going to expire in 8 days, you're more or less capturing the fastest pace of time decay. So a person, for example, could go here and you could click on the bid, and that means you want to sell the 110s, 110 puts. And then they could hold down the control button and go to 106 and click on ask. And that's going to mean that you want to buy those. What that's going to do is it's going to create a credit spread. Now, that credit spread is $4 wide, and it brings in like 92 cents. So this could be something where I think when you get back, this is the thing is this trade would essentially be profitable as long as Micron closes above 109 and 8 cents the end of next week. And it's pulled back a lot. So that would basically, the break even be kind of somewhere down around here, down the 50-day moving average. Below that, the person would have the potential to be assigned shares. So this is something where if a person has an outlook on a stock where they feel bullish about it over the next 3 to 6 months, and they think that it's, kind of neutral in the next 2 to 3 weeks, then a put credit spread or something like this could make sense in a name like Micron. I wanted to mention that. Another one I want to quickly talk about in the options is Alibaba. BABA. Now, it's very interesting to look at what's been happening in these Chinese stocks because the Chinese stocks are actually outperforming in a very interesting way. And so Alibaba here is, with the Chinese kind of, Trump making peace with Beijing and everything else, a lot of this kind of intense negativity toward China could be passing. And looking at Alibaba, look at Baba. Now, this company reports earnings on the 14th of August. So we can go over here now with Alibaba, and let's actually look for something more like August. We see that we have options expiring the 15th of August, which are the monthlies, and a person might actually now be looking to the upside. So here's a stock that, if you look at it on this chart, a move toward 130 might be something people see as being possible. So you could potentially click on these 120s on the ask, meaning it looks to buy, and then hold down control and click on the 130s, meaning you want to sell at the bid. And essentially that's going to create a call spread there for about $2.60. Now, a spread like that has the potential to go up 250, 300% from the stock moving up, about 10 less than 10% to $130. So that's something I wanted to kind of point out in a name like Alibaba here. There have been some interesting things happening. I'm going to talk about some of these other names because I think Chinese stocks have been off people's radar for a long time. But look at NIO. There was a time when NIO was almost as heavily traded as Tesla. And I think it's important just to kind of realize that NIO here is this is a Chinese electric vehicle company. There's been, a real kind of, move in this. And this company has a new car coming out, a new L90 SUV. But I want to just kind of point this out. This is something that was jumping out for me. Another name that's interesting is XPEV. If you actually look at some of these Chinese companies, I mean, some of them, their actual products are mind-blowing. And I mean, the fact is that we might not see them in the United States, but you got to wonder, countries like India, countries like, Indonesia and a lot of people in those countries, Malaysia, over time, those areas, these could be international growth stocks, even if Americans don't really see it. XPEV, this company had this very dramatic run that we talked about at the time. And here it is just kind of holding and consolidating. This company hired a bunch of engineers and they started getting people excited. They're doing more stuff with AI. A lot of these companies have their own self-driving stories in there. I couldn't find any news on it, but it's also kind of starting to move here. So when I'm looking at this price action, the Chinese stocks, we could be seeing, money kind of rotation, institutional money rotating back to Chinese stocks. And I want to just kind of emphasize that. LI. Now, another one is Kingsoft. I mean, this company has been absolutely parabolic at times in the past. KC. And this company, basically, there was China, the government loosened some rules for some of their AI technology for them to kind of serve foreign countries and stuff. This company also historically has been a very strong momentum growth stock, KC. Now, another one is TIGR, which is a Chinese brokerage company, Up FinTech. And this company apparently is just now getting involved in some cryptocurrency products. And if you look at this stock also historically, a lot of these stocks, when you really look at them, we have to realize is that there was this huge move in Chinese stocks. And then in 21 and 22, the Chinese came out and really cracked down on their market, and they've been getting nicer since then. Then Trump came along, and that created new risk, but now maybe that's fading as well. So I think it's important to realize here is that there seems to be something happening in Chinese stocks, even if it's not getting a lot of attention. Just a few of the things that were interesting was there was also a news story of LCID with a deal with, I believe, Uber. So there are some of these kinds of left for dead. It's funny that now that they passed this big bill that cuts EV spending, we're seeing EV stocks come to life. LCID is an EV stock that had this deal with Uber. We also have QS, which does EV batteries. They had a new battery breakthrough recently, and the stock has been ripping. This new battery is called Cobra. I don't know, you can look into it, but massive short squeeze, QS. This is just, I want to just kind of point these things out. Now, another thing is ALB, the lithium stocks. Apparently, the Chinese are going to reduce production. What's interesting about the Chinese now is that in some ways we're seeing more discipline out of China. They've been doing things like shutting down refineries and steel mills that they think are not productive or not efficient. And those things have actually been, they're not doing like you normally see a communist command economy do, which is just mass produce everything, and they're actually showing discipline. And I think it's kind of interesting. They shut down some kind of lithium production in China. So ALB and SQM, these are lithium stocks that are potentially benefiting from that. So those are the main things I wanted to cover. Like you notice, I mean, the key point here is that this market is right now essentially, very calm. It is this tight sideways movement. It's not really volatile. It is not overall very thematic. It is lots of small individual stories, and this exactly follows the model we've outlined with our volatility model, with our volatility cycle. We are now in the stock pickers market, and we could be in this kind of low volatility calm potentially for the time being. There's no real reason to think it has to get all that bearish at this point in time, especially this environment with the Fed plays out. So remember, Jerome Powell on Tuesday, and then the real important part of earnings season gets going after that. That's what we have on the radar ahead of us. And at the end of the month, we're going to get to it. By the end of the month, we do have GDP and stuff. But then the other thing, just don't forget, tomorrow, first thing, we have the housing data. Let's see if that causes any kind of activity in the home builders. Hope everyone has a great day. We'll see you on Monday for State of the Market. Thanks a lot.